So welcome to the continuation of our principles of accounts, where we're going to take a look at the cash book. Actually, what we're doing is we're studying books of prime entry. So we're going to look at different types of books of prime entry. So in this video, we're going to start with the cash book. Then in the second video, we're going to finish with the cash book. So just to show you where we are. So we are still studying procedures for recording business transactions. So we said processing a business begins with recording the information on a source document. Then I use this illustration to give you a visual idea of what this means. So a source document, whenever there's a business transaction, a source document is going to be generated. For example, if you buy something, it's a receipt. Okay, so when you buy something, if of course you are in business, you buy that, or your business buys something, your business is going to receive a receipt. That's a source document. So the next is to identify the accounts involved. What accounts were involved? If you buy with cash, it's the cash account, and whatever you have bought, it might be the account of the thing you have bought. So once you do that, you have to enter this information in what are called subsidiary books or books of prime entry. The subsidiary books are the books of prime entry we're going to study. So these are the first books in which account records are first recorded. So from the source document, you enter in the subsidiary book. So from the subsidiary book, that's when you can post to the collection of all accounts called the ledger. So the first subsidiary book we're going to look at is the cash book. So just an introduction to the books of prime entry. They are sometimes called subsidiary books, like I mentioned, and the definition is they are books where certain types of transactions are recorded first before posting them to the ledger. So example of these books of prime entry are the cash book, the petty cash book, the purchases day book, the sales day book, the purchases returns day book, the sales returns day book, and the general journal, which is also called the journal proper. So the cash book is a book of prime entry in which cash or bank transactions are recorded. Okay, so cash transactions and bank transactions are recorded in the cash book. So when you have cash book, don't think it's just cash, but also bank. So you have to keep that. In short, the cash book has the cash account and the bank account. The cash account is where the actual cash in terms of notes and coins is recorded. Then the bank is for transactions, of course, that involve the check and all banking services. So in summary, the cash book has the cash account and the bank account has and the bank account side by side. So it has two sides. One side has the cash account, the other side has the bank account. That's how the cash book is. Cash transactions involving the exchange of notes and coins with goods are used to compile the cash account, while transactions involving checks are used to compile the bank account. So one thing you should note about the cash book is it is the only book of prime entry that is also part of the ledger. Other books of prime entry, when you enter details in them, you have to post the transactions to the ledger. But for the cash book, you don't have to post to the ledger because it is also part of the ledger. So the cash book, of course, is the real account, and the application of the double entry, just like we discussed concerning real accounts, is you debit what comes in, the inflows, the increase in value, and you credit what goes out, the outflows or the decrease in value. Because of this, applying this, that is what should be debited and what should be credited. The debit side of the cash book, that is bank or cash account, records cash inflows from. So all this information, all these have to do with cash coming into the business, and the debit side is going to record this. So sales, when you sell, it means you are receiving money. It can be in form of cash or in terms of a check. So you're recording the cash account or the bank account. Rent received, you're receiving money. Commission received, you're receiving money. Receipts from debtors, someone owes you money, then they pay money. Okay, then another interesting one is transfers of cash from the bank to the office. which is also called contra entries. So a contra entry is, of course, where you get money from the bank, you put in your business. So the cash account of your business is going to receive that money, while the bank account is going to give away that money. So for this one, you only debit the cash account, but the bank account, you credit it, it's going to give away. So this is a special one. It's going to affect them in an opposite way. Cash withdrawals of personal use, drawings. So even though if you get money for personal use, even though that has nothing to do with your business, but you're affecting your business, so an account has to be recorded of how much money you're getting from the business. So since that money uh, you're going to receive, so the account that is going to concentrate on your activity, we're going to show that it received some money. So the money that you get and for personal use is also going to be on the debit side of the cash account. Okay, the credit side of the cash book. So now, what about the other side? Of course, I've talked about the contra entry, where the bank account is going to show on the credit side, where the cash account is going to show on the debit side. Well, for the credit side, we have these payments to suppliers. You have paid cash purchases. You have bought something with cash, so money has been given out. Rent and rates. You have paid for rent and rates. Salaries and wages. Bills. So this is money that the business is giving away, so they are going to be on the credit side. Also, transfer of cash to bank account, another contra entry, the opposite of the one on top. So the one on top, we're getting money from the bank to the cash account, but we can have a lot of money, we don't want to be keeping money, so want to deposit. So money is going to be transferred from the cash to the bank. That is also a contra. Means that the cash is going to be credited, it's going to give away, and the bank is going to receive. So it's going to be debited. Credit cash account, debit bank account. So here are some important details about the cash book, and I want you to imagine this to be as realistic as possible. Be as realistic as possible. So the debit balance on either cash or bank account of the cash book represents the cash available in hand. So the debit side, remember, is where we record the money that we receive, and the credit side is where we record the money that we give away. So the balance, when you are done with the cash book, there is a balance. That's the money that remains. So if the money remains on the debit side, it means there is money that you have. Okay, there is money that you have on the side of the money that you have received. There's still some money there that is sitting. So if it's the cash account, it means you have some actual cash, some paper notes and coins which you can count. So if you have 20 kwacha on the debit side, it means you have the 20 kwacha which you can see. So even when in the bank account, if there is a balance on the debit side, it means you have money in the bank. What about the credit side? If you have a balance on the credit side of the cash account, it means you have given away money that you don't have. How can you give away money that you don't have? It's not possible. So it's not possible to have a balance on the credit side of the cash account. What about the bank account? It means you have again given away money that you don't have in the bank. But for the bank account, it's possible. It means you have overdrawn more than what you were expected. You have taken money from the bank. You have borrowed from the bank. You have a loan from the bank. So that is called bank overdraft, when you have overdrawn more than you should overdraw. So it means you're supposed to pay back. So mean that the money that you gave away is nkongole that you are having that you're having to the bank. The bank needs the money to be paid at some point. So a special case sometimes, which is the one I have just explained for having a credit balance, a special case sometimes occurs where the bank account of the cash book shows a credit balance. So this is just a summary of what I have just said. This means that the account has been overdrawn. The state is called a bank overdraft, meaning that the business has borrowed from the bank. So there are two types of cash books. There is a 2-column cash book and a 3-column cash book. So we're going to end this video with a 2-column cash book. In the next video, we're going to take a look at a 3-column cash book. So when you know a 2-column cash book, a 3-column cash book is not complicated because we're just going to add one more column to the 2-column cash book. So it's going to be simple. So we're going to learn through examples. The approach we're going to use is we're going to know the format of a 2-column cash book. How do you draw a 2-column cash book? Then after that, we're going to enter some transactions into the cash book, knowing just how to deal with certain special type of transactions. The knowledge can be extended to any other type of transaction that you might face. So here is the example. Record transactions in D. Nyelenda's cash book for January 2004. So in the bank there was a balance of 6 million. Then he made sales by check worth 5,500,000. Then he bought goods paid by check worth 1,500,000. Then on the 22nd, he withdrew cash from the bank for business use for 4,500,000. Then he paid for traveling expenses by cash, an amount of 400,000. Then he paid salaries by check worth 2 million. So this is the layout for the 2-column cash book. So on top is the name of the business owner or the name of the account. So in this case it's D. Nyelenda's cash book. Okay, then at the end is the trading period. So this was January 2004. So this is when all this happened. So the first column we put the date, the second we put the details, the third is called the folio column. So this is a special column for writing certain symbols that are going to tell you some special transactions here. Okay, then what makes this to be called a 2-column cash book is because it has a cash account and a bank account. Cash account and a bank account. Okay, that's why it's called 2-column cash book. There's the first column and the second column. So in the cash account here, we have the debit side and the credit side, and in the bank account we have the debit side and the credit side. Okay, so let's start entering the transactions. So the first transaction is bank 6 million. So this is the balance in the bank. So first you write the date, that this is a transaction on January the 1st or 1st January. You can write 1 dash Jan or Jan dash 1. Then the details is these are called balances. So what do they mean? Balances or balance, it means it's the money in the previous trading period. Okay, so let's say the previous trading period is 2003. Okay, so the money that was left in the cash account and the bank account is going to be brought forward to this new year 2004. Okay, so we write that, or we write that by writing balance, or we show that by writing balance. So I've used the word balances because normally there's the cash account balance and the bank account balance. Okay, the money that is in the bank by the end of the previous trading period, and the money that is in the cash account by the end of the previous trading period. Okay, so I'm using the word trading period because that's how business describe their time. So if you start a business this year, all the time you'll be doing business, that's your trading period. So we say trading period instead of saying years, because someone can start their business in September 2023 and they'll clock 1 year in September 2024. So that's their own trading period. So not all business can have the same trading periods. Okay, so in accounts, that's very important. Okay, let's go back to the cash book. So the balance was in the bank account, but we're going to put B/D, which simply means brought down, meaning that this balance is from the previous trading period. So the amount is 6 million. So we have 6 million in the bank. So the next transaction is paid check 5,500,000. By the way, if we had a cash balance, we could have also put it here in the same line, could have written it here. Okay, let's go back. So we had this check we made sales and received money by check worth 5,500,000. Okay, so we write the date there. We are just going to show the date since the month is already written. Then we're going to indicate the nature of the transaction, sales. Okay, meaning that the two accounts that were involved were sales account and bank account. So we write sales there. Then in the bank account to show that we received 5,500,000. So mean that the total amount of money in the bank account is 11,500,000. The next transaction is bought goods paid by check worth 1,500,000. So now we have made the purchase. So on 20th we made the purchase using the check. So the bank account is going to be credited because money has moved outside the bank account, so it's going to be credited. So 1,500 million. The next is bought a motor vehicle paid by check by 10 million. So let's go back a bit. We had 11,500. We have made purchases worth 1,500,000, meaning that we have remained with 10 million. Then we buy a motor vehicle by spending 10 million, meaning that we don't have money in the bank account now. But anyway, I just wanted you to know that when we use this money, the 10 million that was in the bank account, to buy the motor vehicle, it means that we won't have money in the bank account. Anyway, but this happened on 22nd, motor vehicle worth 10 million, meaning that we don't have any money because we had when you add 6 million, 5,500,000, it will give you 11,500,000. If you subtract 1,500,000, you remain with 10 million. So then from 10 million again, you subtract 10 million, you remove 10 million from the bank, you remain with 0 million. The next is withdraw cash from the bank for business use. So money was taken from the bank with 4,500,000 for business use. Interesting. So where did the money come from? In the bank account, there is no money. So in such a case, it means we have borrowed from the bank. This is what I'd explained to be called an overdraft. So we had borrowed from the bank. We overdrew more than we had. We had 0, but we overdrew 4,500,000. So this is called overdraft, meaning that we have borrowed from the bank. So now this is a special type of transaction because there's no value that is going out or coming out out from the business. There's no money of value that is going outside the business or coming into the business. The money or the value is being transferred from one account to another, from bank to cash account. So this is called contra. So the way to record this, you write the date, then you write the details. So the details will start with where the money is going to where the money is coming. So money is going to cash from the bank. When we do that, in the folio here, you put a C to show that this is a contra. That's what this type of transaction is called, a contra transaction. So in this contra transaction, there was this money that was received from the bank, which is 4,500,000, and the bank gave away 4,500,000. The next is paid for traveling expenses by cash, 400,000. So on this date, our traveling expenses were paid. Okay, so they were paid by cash. Okay, so see, 400,000. So out of this 4,500,000, we have removed 400,000 500,000. The next and the last one is paid salaries by check, 2 million. Okay, so our salaries were paid by check worth 2 million. So the bank account is given, that's why there's 2 million here. Okay, so now we are done with the transaction. What do we do next? We have to balance off the cash book. How do we balance off? We add what is on the debit side, then we also add what is on the credit side. We look at the totals and see which one is big. The big one is what we record here and here. So here we have just one number, 4,500,000. Here we have 400,000. This is big. So we're going to first write balances here to show that these are going to be the balances that are going to be transferred into the next trading period. Okay, so we write here balances, and also here down we're going to write balances. We'll leave a space here. Okay, so we write balances, and there should be a line here, balances, because we're going to record some things here. Then here also there should be a line where we're going to record some things. Then again balances, again we're going to record some things here. Okay, so balances, so we go here first. By the way, you have to write C/D to show that what you're going to record here is the balance carried down. The balance carried down is what is going to be the balance in the next period. So this in the previous period was what was here. Okay, so but in this period we're going to have a number here. This number is what they are going to use as balances in the next period. Okay, so now the total, the highest total is this one, so I'm going to write it here and also here. Okay, so now what this implies is when you add everything here, they should give you this, and when you add everything here, they should give you this. But there's just 400,000 here. So to balance this side, you need to put a number here. So how do you put a number? So the total that you had got from here and the total that you had gotten from here, you subtract the smaller total from the larger total. In this case, the larger total is this side, the smaller total is this side. The larger total is 4,500,000, or the smaller total is 400,000. So when you subtract, we're going to get sorry, this is 4,500,000. I don't know what I had said. Then this one is 400,000. So when you subtract this, you're going to get 4,100,000. Okay, so that's the value we're going to put here. Okay, so when you put this value here, we're also going to put it here. That will be the balance carried down. So we're going to put it there and there. So this is the balance carried down. So how to interpret this is, in our cash account we have 4,100,000. 4,100,000, that's the money in our cash account. Okay, so which means next trading period, this is the money we're going to be using to buy things and the likes. So we're going to do the same here. So here we're going to understand it more since there are more numbers here. So let me just get my calculator. So again, we add everything on the debit and also on the credit. We see which one is big. So if we add 6 million and 5,500,000, we're going to get 11,500,000. What about this side? So if we add 1,500 million plus 10 million plus 4, it's 4,500,000 plus 2 million. So we're getting 18 million this side. So mean that this side is big. We have 18 million here, and here we have 11,500. So there should be 18 million here, but I think in writing I've made a mistake. I've written 60 million. The calculations at first I did not do properly. Okay, so let me just put all the numbers. So here it's supposed to be 18 million if my calculations are okay. Maybe I did not punch my calculator very well. 1,500,000 plus 10 million is going to be 11,500,000 plus 4 million is going to be 15,500,000. It's going to be 60 million actually. Then 18, so it's supposed to be 18. So I made a mistake. It's supposed to be 18 million here and 18 million here. So now when you have this 18 million, you have to do this 80 million is the highest of the two totals. Here we had gotten 11.5 when we added this and this. Then here, after adding this, we have gotten 18 million. So 18 million is bigger than 11,500,000. So I'm going to write 18 million here and 18 million here. Okay, so now to balance off, when we add this, we get 18 million, which is of course because this 18 million comes from when we add this, and this other side, when we add this, it should give us 18 million. So we need the number here. So assuming that this number, haven't figured it out. So what you do is you do 18 million minus 11,500,000. So when you do that, minus 11,500,000, you're going to get 6,500,000. So this is the 6,500,000 you put here. This is the same number you're going to write down here as the balance for next year. So next year, or what this implies, having a balance on the credit side. If you look at the cash account, the balance is on the debit. The debit side shows the money that we have, the money that we have received. Okay, so or the amount of increase in the value. So this is our money. This is the money that we have as a business. Well, here in the bank, the money is on the credit side. It means that this money is not ours, it's people's money. Okay, so this is an overdraft, or it's because of an overdraft. So this is how to deal with the 2-column cash book. I know this has been the longest of the accounts lesson, but hope you have gotten a thing or two. If you do 2 or 3 questions, you'll see that a 2-column cash book is simple. Happy solving.